With markets hitting new highs, the interesting thing is we have more and more companies trading below the 200-day moving average, and actually some interesting companies hitting 52-week lows, which tends to be opportunities we can look at. So in this video, I'm going to talk about a few companies hitting 52-week lows that we need to take a second look at. Now, if you're new to the channel, welcome into Compounding Capital. Consider subscribing, smash that thumbs up. On this channel, we're going to take our emotions out of the equation, and we're going to let the fundamentals dictate where price should be and where we should possibly be looking at an entry point. As always, this is not financial advice, and let's get into today's video. Before we get into stock number one, I did want to point out that early on in this bull market, we had over 97% of companies trading above the 200-day moving average. Now it's moved down to roughly 60% of companies are trading above the 200-day moving average, which means that 40% of companies could be closer to bearish territory, and we're starting to see that dynamic take place with some interesting names. Now, one of the areas that are getting hit pretty hard are going to be the packaged food companies. Everything from Conagra Brands to Smuckers, and even the big dogs like Pepsi are getting hit right now. In one of the most incredible bull runs we've seen, Pepsi is down 11% and actually down 17% from recent highs, which is now leaving a yield on the table of 3.63%. Not only does Pepsi offer a variety of beverages from Gatorade to Mountain Dew, but it also acquired Frito-Lay brands, which does own Doritos, Cheetos, Fritos, Tostitos, Sun Chips, and many other brands underneath the Pepsi umbrella. So trading at a forward P of 18 times, obviously this is not a cheap company, but we can see the massive moat behind this organization. Now, when we're talking about a company trading at 18 times, we definitely want to see stronger revenue growth, and forward revenue growth looks to be anywhere between 3 and 4%. We can see that revenue growth year over year was very weak, and I think that's why we're seeing multiples contract on Pepsi, along with the fact that a lot of packaged foods overall are definitely trading down. When we come down to net income margins, we see here that they do have very strong margins. Definitely one of the most impressive things about the company is the fact that it's paid dividends 52 consecutive years in a row and has grown those dividends. Now, when we go to stock analysis, we have analysts as low as 155 and as high as 200. Currently, the stock is trading at 149 and as good as low as 140, which is a 52-week low in the stock. When we take it to Schwab, Schwab believes it's going to be an underperformer, and this was reiterated actually yesterday at 124. So Schwab is not really high on the valuation of Pepsi right now. Morningstar gives it a 4-star rating with a wide moat. They did this analysis when it was trading around 165, and we can see here they believe fair market value is sitting closer to 174. Now, the one thing that surprised me about Pepsi, plugging in my analysis here, was the fact that it is carrying a tremendous amount of debt. Roughly has $10 billion of cash and cash equivalents, but $44 billion of debt, which was kind of surprising for me. I'm running my analysis with 3% growth, basically saying it's going to keep up with inflation, and anything above and beyond that is obviously going to increase my equity position at longer term. We always want to err on caution and not do anything too outrageous here. If it grows at 4 and 5%, we're going to see pretty substantial returns here. Putting an 8% required rate of return, that is on top of a 3.65% dividend. So we are looking for a double-digit rate of return in Pepsi when we factor in total returns here. Now, putting a 15 multiple to EBITDA on the stock gives me about $111 ideal stock price here. Just to put things in perspective, Coca-Cola trades for a 20 multiple. So if we threw a 20 multiple on the stock, we can see that it technically would be a buy at these levels. For me, I'm comfortable using a 15, 16 multiple on the stock. So for me, I would be looking anywhere between $100 to about $118 a share on Pepsi. So that was my analysis on Pepsi. You guys can see here where I think future value could be for the stock, sitting closer to $270 a share. Now, this is also going to be dependent on buybacks and revenue growth. If they can grow above 3% and they're doing a lot of buybacks, then obviously my price target's going to change. But as of right now, basically sitting between 100 and call it 120 a share, where I think fair market value is and where I need to buy the stock in order to get over a 10% rate of return. We can see here that they're projected to do right around $8.70 of earnings. So if we take that 870 and we put a 15 multiple on the stock, we're basically looking at a $130 price target. So as you guys can see here, to me, Coca-Cola is still a little overvalued. Now, the reason why I'm putting a 15 multiple on the stock is because it's growing about 3 to 4%. I don't think it's going to have any outlandish revenue growth. I'm definitely keeping my buy target around that 100 to call it 120. I believe that builds enough safety to get an outsized rate of return at accumulating shares at Pepsi. At accumulating shares of Pepsi at that level, it also creates a higher dividend yield within the portfolio as well. Next, we're going to dive into Uber together. Once again, I'm going to plug in the numbers step by step with you so we can talk through Uber's valuation. I actually want to start with the analysis here. We have a low of 77, a high of 120. Currently, the stock is trading around $68. And this did recently hit a 52-week low of around $55 a share. We can see that it bounced pretty hard off of those levels. So maybe we get another opportunity on a pullback here, but we're going to still dig into Uber here. We can see the steady increase in revenue, and we're starting to have earnings following that revenue. So now we're seeing a profitable high growth company where we can start plugging in projectable analysis here. Schwab gives it a C rating, which is basically a market performance. Morningstar gives it a 3-star rating. Once again, a market performance. They believe fair market sitting closer to $79, and currently the stock's trading around $68, which doesn't give it a tremendous amount of upside here. So we can see in the trailing 12 months, they are definitely getting some nice revenue growth, still double digits here. So we're looking at free cash flow of around $6 billion, cash and cash equivalents sitting around $5.4 billion, and total debt sitting around $11 billion. So overall, I would say the balance sheet is pretty clean. The one thing I do want to point out here is this share dilution, which I'm sure is attributed to stock-based compensation, something we definitely want to keep an eye on as well and equate for in our analysis. Now, stock analysis has them growing still around 15-16%. I'm going to err on a little bit of caution here. I'm going to say 13, 12, and 10% for me personally. Now, obviously, I do think they can do a little bit better than this, but I do want to err on a little bit of caution because as these numbers get larger and larger, it does get harder to keep that double-digit growth. Now, on a company growing 15-16% and trading at a forward PE of 36 times, the valuation seems pretty reasonable when we look at it from that perspective. Now, the problem is, what is the competition going to look like in the future? Can they maintain these growth rates? And that's why I'm erring on a little bit of caution. We get two different analyses here. As you guys can see, by 2033, this could definitely be over $100 stock. I think anything between $50 to $55 was a good purchase. So on that pullback on the 52-week low, if we get another opportunity, I basically think anything between $50 to $60 is very interesting on Uber with the growth potential going forward. And the fact that the fundamentals are actually starting to come through on the company, and we're starting to see those fundamentals get stronger and stronger. The EBITDA margins are getting better. The free cash flow margins are going to get better. And as the business gets more and more efficient and more integrated into our daily lives, this one is definitely very interesting. And that was my analysis on Uber and Pepsi. Both are trading in some interesting territories here, where if we keep seeing these companies trading in bear territory and we keep seeing the selling off, at least we have an ideal stock price here lined up for both of these names. Now, the third thing I want to talk about is the recent move in gold prices and some of the underperformance in the gold miners that I do think could technically catch up with gold prices. Now, I pointed this out before, and I pointed out Barrick Gold that was trading around $13, $14 a share, shot up to $22 a share, now back down to $16 a share. Let's take a quick look at this one. I'm not going to get too nitty gritty into the numbers, but I do want to point out a few different things here. When we look at forecasts, we have an 18 low and a 27 high. Currently, the stock is trading at $16 a share. And as I stated before, it was trading in the $15 range. And once again, we had that nice uptrend as gold was starting to skyrocket, and we had that big sell-off here. Now, working overseas, there were some litigation problems here. We have to see if this plays out, but there's been some bad headlines with Barrick Gold's employees and management, and so we have to see these things play out. But that is why I believe we are seeing a pretty substantial sell-off. Now, we see here Barrick Gold is trading below peers, and from a gap basis is trading substantially cheap versus its peers. Now, we're looking at a company trading around 14-15 times earnings that still has the ability to grow double digits here because of the gold prices. Now, the X factor in all of this is capital expenditures. What is it going to cost for those manpowers? Once again, Barrick Gold does have some pretty good margins here, 13% net income margins. Now, this is a company that has paid a dividend for 28 consecutive years. We come down here, we can see that obviously the dividend payments are all over the place because it's really based on profits. When we look at Schwab, they give it basically a market perform with a C rating. And when we look at Morningstar, this is a 5-star rating for Morningstar. So Morningstar is probably a lot more bullish on gold, maybe thinking that inflation is going to be a little hotter than we all anticipate, which could be a nice backdrop for gold. And they believe fair market value sitting closer to $23 a share. So wanted to also drop this one on you guys as well. Hopefully you guys enjoyed my dive in onto 3 names that were recently trading at 52-week lows that I think have some pretty interesting opportunities. As always, guys, really appreciate your time, and we will see you all in the next one.